chapter 6 handout. We may not get there, but then we're going to start sampling overview. We might finish it, I'm not sure. Okay. So let's go to chapter 6. Okay, so I think we stopped on number 3. There's no B. Okay. So well, let's go through it. So this is the integrity and reputation of the client, and this is the most important factor. I think we talked about this a little bit last week. And if there is a successor auditor, if there isn't a previous auditor, you are required as the successor to try to contact them. And you have to be allowed by the client. So you must get permission from the client to contact him. If the client does not give you permission, generally speaking, you do not take the audit. And unless you have a really good reason for doing it, like CPA's in jail or something like that. But generally speaking, you have to you are required to get the client is supposed to give you the permission to talk with the previous auditor, and you basically get information on them as far as you're trying to get see if you can reasonably trust the management. You know that the integrity and reputation of the client is absolutely key, and the ICBA really jumps into that. I'm going to ask a really embarrassing question. Is there a C for this one, or a B? Did I delete the B?
No.
Yeah,
So
there's no B.
There's no B. Okay, I guess we could just pull it up and take a look. See what I did here. Okay, well, I'm not sure what I did here. All right. Well, sorry about that. I'm not sure why I don't have a B here. Anyway, so speaking to other third parties. So you're not only going to talk to the previous CPA firms, but also get information from their bankers, their lawyers, customers, vendors, that sort of thing. If you can get a hold of these people and ask them about, you know, their relationship with the company. Background services, these are usually done by services. They can't be done by the CPA from themselves. A lot of times they'll use a service for those. And they have some that are, you know, they provide quite a bit of information, actually. Okay. This is a big one. Shopping around for accounting principles. All right, shopping around for accounting principles. What this is that a client looks for a CPA firm that will agree with a disputed accounting principle. So this is when a client will say, okay, well, you guys are not the only CPA, you know, you get into a dispute about something. They'll say, well, you're not the only CPA firm in the world, we'll find another one. And they start calling around and they say, well, by the way, we account for revenue like this. Is that okay with you? And if they say yes or no, you know, if they say yes, then they say, okay, well, we want you to be our auditors. So shopping is when you start looking for, like I say, the client starts looking for a CPA firm that will agree to their, whatever their disputed accounting principle is. And that obviously is pretty much discouraged by the AICPA, that if somebody is shopping around for a disputed accounting principle, generally you should say, well, it depends on the nature of it, and you know, until we do the audit, we don't know. All right, client continuance. It is possible that you take on a client and the decision there should be a decision made each year. Whether or not you're going to, oops. And obviously, if you have disputes with the client and so on and so forth, that that definitely will have an impact on whether you're going to continue with them. So client continuance is another big one that comes into play after the first year. Okay. Client acceptance questions. Attempt to communicate with the successor between the successor and present auditor should be initiated by which one? Or neither? So who should initiate it? Remember the successor, this is the new auditor. Predecessor is the old auditor. So who has a responsibility to initiate communication?
The client?
Well, the client has to approve it.
Oh, okay.
Who contacts who? Who has a responsibility to contact the other one? Is it the successor or the predecessor?
Oh, got it.
But either way, the client does have to approve it, though. That's true.
Oh, the predecessor.
Actually, the new one.
Give it, wait a minute, must give the predecessor audit permission to share with the successor. Yeah.
So the new auditor coming in, they are the ones that need to initiate. The old auditor has no responsibility to try to figure out who the new auditor is and contact them. But the new one does. And generally this is done, should be done before they accept the engagement. Oh, I just, I'm an idiot. All right. The attempt at communication should be made. Already said it. Before the engagement is accepted. Okay, the successor auditor should inquire about which of the following? So the successor auditor contacts the predecessor. They're doing this before the audit. And the question is, what do they inquire about? Now remember, they haven't taken the audit yet. And I think
would that be communication with the management?
certainly that would be one of them. Yep. And this one, there's more than one.
Oh.
But yeah, communication with management, definitely.
I want to say integrity of management.
Yes, absolutely. That, and the CPA would say that's the most important one. Probably also here, communications. Reason for changing auditors, that's another one. And first one also would be any disagreements they would have. Now, the things they went look at specific audit steps. They have their own audit program. The successor will have their own audit program. They're not going to ask about audit step. Reason for testing specific accounts. At least initially, that's not going to be what they're going to ask about because they don't know which accounts that were specifically tested. And even if they did, I mean, they have their own audit program and they will determine what accounts need to be tested. Okay. 8K report. I don't think did we talk about the 8K report? That must be what I took out by accident. The 8K report. No, it's not. It's right here. I'm sorry.
Yeah.
Okay, here's the other stuff the 8K report has on it. I was all excited. I thought I figured out my error. Oops. So the reason you're looking at the 8K report, the 8K report is really an overall report that's given to the SEC. And it's given, it's basically, the 8K report is not just for auditing or changing auditors. It's for anything that happens this big with a company. So if the company buys a competitor, they're filing 8K. If they get a new chief financial officer, they file an 8K. Anything that's significant that happens in the company, they have to let the SEC know about it, and they file an 8K. One of those things, of the many things that could be an 8K, one of those things is if they change their auditors, they have to file an 8K. Now, if you think about it, the SEC just wants to know who the new auditor is. So there really isn't too much in there. It's going to have that they change their auditors. They don't have to give a reason. They don't need to talk about the fees. The last two here, they do need to have in there. Significant agreements with auditors over the last 3 years. And the previous auditor's response to the disagreements. So this is all they want to know. And the 8K is basically, we changed auditors, you don't have to tell them why. Any significant disagreements over the last 3 years. And the predecessor auditor's responses to significant disagreements. I probably didn't also tell you guys, but I should have told you about the 8K report for when it comes to auditing is changing auditors is they send, so an 8K report is filed by the client. So let's say IBM's changing auditors. They file an 8K report. The SEC says, okay, let's hear all the agreements for the last 3 years. And they'll put down any disagreements they have for the last 3 years, if they have any. Those, whatever that response is then sent to the predecessor auditor, the old auditors, and the SEC, it's a yes/no question. Is this everything? Yes or no? If they say yes, everything's fine. If they say no, then the SEC goes back to the client and says, you didn't give us everything. Give us some more. So it's basically a yes/no question, whether that's everything that they have or not. It isn't, okay, you can add some more, fill in the blanks. It's up to the client to disclose everything that is was a significant disagreement. Okay. Okay, which of the following consideration is most important when obtaining new clients? They call engagement risks. So which one of these would be important? And more than one. Well, let's go down the list. Reputation of clients, owners, directors, officers. Okay,
Yes, that would be important.
you guys are toying with me, of course. Yeah, that one's be very important. Nationality of owners,
No.
credit rating of client. This one might, and this one is especially, it's a bigger risk if you have a client that's going bankrupt. Now, if that's not really part of the, you know, if you have enough information that they're not going bankrupt, and the reason why it's if a client's going bankrupt, there's a couple of reasons why it's more risky. If a client's going bankrupt, more risky. Oops, not. Let me get this up here. It'd be more risk for. There's actually two risks that kind of come into play here. If they're going bankrupt, more risk for lawsuits. If the client does get sued, you know, who are they? So if the client goes bankrupt and the lawsuits start flying, who are the people gonna, you know, who are the investors going to sue? They're not going to sue the client. The client doesn't have any money, they're bankrupt. The only person standing, or, you know, only people standing with money are the auditors. So a lot of times the auditors get hit with lawsuits when a company goes bankrupt, because they're the only ones that really can be sued. The company's bankrupt, you're not going to get any money out of the company. So, all right. And there's more financial, more risk for financial statement fraud. If a company's doing really poorly, that's more incentive for them to say cook the books. A company that's doing really well is not going to cook the books. There's, you know, there's no reason to, generally speaking. The more risk for financial statement fraud comes from companies that are going bankrupt, that they have a bigger incentive to create a fraud than, say, a company that's doing well. Okay, so the credit rating, it can be, especially if the company looks like they're maybe going bankrupt, it can be one of those things you look at. Marital status of owners.
I don't think that would be important. Risk, or would it? No.
Pending litigation, it might be, especially if it has something to do with other clients and that sort of thing. How about independence to the audit, to the auditor, independence of the auditor to the client?
No.
Actually, yes. That's the whole chapter 3 thing with the independence. You remember the owning stock in the client and that kind of thing. And by the way, this is one of the weird ones of our profession, that our clients, you know, they can't be our friends. They can't be, you know, which is way different than, you know, doctors and lawyers and that. You know, they can, a doctor can, you know, give medicine or whatever to family members, and that's not that big a deal, but it is for a auditors. How about this one? Auditors' competence in the client's industry.
Yep.
So these would be the major, you know, some of the major things you'd look at. The big one, the ACCT will tell you that this one is really big. You know, the reputation of it. And the independence one, this is like the chapter 3 stuff that we just did. And this one is important. I think it's the only thing we lend to financial statements is credibility. So we can't lay credibility, we should do it. The engagement letter. This is kind of spread out for some reason. I must have been altering this handout when I don't know what. But anyway, the engagement letter usually. The engagement letter is sort of like a contract. And basically, the engagement letter is going to tell it's going to have kind of the outline of the contract, basically between the auditor and the client. Now, the engagement letter is like any other contract. It generally does not have to be in writing. Now, it's obviously strongly suggested that it is in writing to avoid any problems or misconceptions and all that kind of stuff. But the engagement letter, is one of those things, but it is like a contract, and virtually all CPA firms are going to, use a contract, use an engagement letter. But basically, the things that are going to be spelled out are obviously the services we perform are going to be in there. Auditor's responsibility, generally accepted auditing standards, limitations on the audit. And so this is another big one. Materiality, you don't look for everything. And sometimes people are surprised by this. Reasonable assurance. Some people think an audit is a stamp of approval. It's really not. It's reasonable assurance. It's an opinion. And inherent limitations of internal controls, which I don't think we've talked about. Internal controls are chapter 7 and 8. And that is that internal controls, they have limitations to them. Well, I gotta give you an obvious one. Oops, what did I just do? I did something funny here. Limitation of internal control, a big one is management override, when management overrides the controls. So if you're working as an accountant and the president comes down and says, here, I want you to make this entry, we want to increase our sales by this, and you say, well, I can't do that. There's there's no background, there's no documents or anything. I can't just. And the president says, well, either you make that journal entry or you can clean your desk out. So whichever you want to do. So that is management overriding the controls, right? So that is one of the limitations of internal control. It doesn't matter how well the control is made if management overrides it. Okay, it talks about management's responsibility for the financial statements, for the internal controls, and this is a big one, provide auditor with access to all relevant information. A lot of people don't understand that you have to look at everything that goes on the financial statements, and you cannot do an audit unless they do that. Document retention. This is something we haven't talked about. AICPA must keep it for 5 years. And PCAOB for 7. So if it is a non-issuer, if it's privately held, 5 years. I'm sorry, I'm not typing very well here. If it is an issuer, 7 years. So you must keep the document retention. Must be kept for 5 years for non-issuers and 7 years for issuers. Financial statement agreement with other management documents. This is one that, especially for publicly traded companies, comes up. So the financial statement must must be in agreement with other management documents. I'll tell you what I mean by that. So maybe the company has in their annual report saying that their sales are, making this number up, 48 million. You're doing the audit and you know that the sales are actually, 42 million. That's a problem because they're putting out that it's, their sales are 48 million when they're really not. So management's other documents have to be in agreement with the documents that from the audited statements. So letting them know that, look, whatever you put in your annual report or brochures or anything you hand to investors must follow the same, amounts that we have in for these other financial statements. So management's other documents must agree with this, with these, with the audited financial statements. And the boring stuff, blah, 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 time, fees, specialists, all that kind of stuff. Okay. Staffing, need for specialists. The one that is almost always given in every auditing book is a gemologist. So you're auditing a store and they sell jewelry, either part jewelry or maybe it's an entire jewelry store. Hey, we're accountants, so you hold up 2 diamonds. I have no idea what the price is for either one of them, or even one's better than the other, blah, blah, blah. So you hire a gemologist. These gemologists will come in and they can actually put a dollar amount to each of those diamonds. So a gemologist is one of those specialists you can have come in. They'll be part of the audit team and they'll come in, but their only job will be to, appraise the value of the diamonds. So access the need for specialists, access the need for IT personnel. This is almost every audit. Every large audit will have a okay, use of internal auditors. This one is kind of interesting, a little bit. I was an internal auditor, so this was exactly what I was. I worked with the external auditors quite a bit. And these are the things that they look for internal auditors. Objectivity, are they objective in what they do? Competent, and do they have some kind of quality control, some kind of feedback as far as how all these people are, how well their work is. So objectivity is hopefully some freedom from bias. Confidence. And quality control. Okay, so use of internal auditors. Now, it might sound strange, why are you using internal auditors? There's actually a really good reason why they use internal auditors. And they use internal auditors because a lot of times internal auditors know way more about the company than the external auditors. And I can tell you when I was working for, I worked for Navistar and US Steel, the external auditors that would come in, and you read through their stuff, a lot of times it was wrong or, wasn't complete. But you got to remember that a couple of things. First of all, they're only looking for things that are material, so their work's not gonna be as detailed as ours would be. But also, they don't have the time, you know, they may have a few days to go over inventory. Whereas we would have weeks to go over inventory on any given, you know, assembly plant or whatever. So for them, a lot of times they would like to see our work, you know, what we came up with, where the problems were, all that kind of stuff with the testing and all that. To know where they should look for stuff, because again, you know, we may have 8 weeks, we may have, you know, whatever. 40 days or whatever to work on these, where they may have 4. So a lot of times they'll look at the internal auditors' work. Because especially if they're objective and they are, you know, competent and all that kind of stuff. So that they have an idea of what they're looking at. It's a real jumpstart to their process. And I can't tell you how many times I worked in inventory. Inventory is big in both Navistar and US. So I was always talking with these people because they would always have, you know, questions about inventory. It's a really big account. And again, just dumb luck. I don't know why I was inventory guy, but that's what I was. And so I would always talk to these people about it. And, you know, again, you know, I would try to fill in the blanks that they'd have but still be, you know, cognizant that what we're looking for and what they're looking for, the dollar amounts are way different. So, but anyway, so a lot of times they'll use the internal auditors. They'll also use us for testing. And a lot of times we would be used for doing tests. Now, we would just do the tests the way that they were laid out. And again, someone would come through and evaluate our work, but we would do the test. Why? Because we're familiar with the systems and all that kind of stuff. We would not make any decisions. So there would not be any decisions made by the internal auditors. All the decisions would be made by the external auditors. We would simply be doing the work that they would prescribe, whatever they prescribed for us to do, we would do it. So. Okay. What time is it? Okay. Time budget. Put that on the side page. Interim work and year-end audit work. Interim work. Get this up here. Some work can be done before year end. Example. Sales for oops. For January through September. Okay. All right. So a lot of times you can have, you know, if you're gonna do audit for the whole year, well, there's nothing wrong with auditing, you know, all those sales for January through September. There's no reason why you can't audit those in October. You know, get 3/4 of your work knocked out. So interim work is stuff that can be done before year end. Now, another thing that happens a lot of times is that most large retailers, oops. Oops, will take inventory. we'll take inventory throughout the year. So for instance, I may have already talked about this. If you go like Walmart, something like that, they don't stop at the end of the year and take one big inventory at the end of the year. They'll do it throughout the year. So if you go in there late at night, you know, if you have, especially if you find like a Walmart that's open 24 hours a day, if you go in at, you know, 1 a.m. or something, you'll see a bunch of people, you know, and they'll have the rows of inventory marked off, and there'll be people taking inventory down that row. And what they do is, you know, 1 week they'll do this inventory, and then the next week they shift and do another inventory. A lot of times these are people who are specially trained just to do that. And if you're an auditor, a lot of times if you're going to observe them taking inventory, you know, 1 o'clock in the morning, you'll be in Walmart watching their procedures and how they take inventory. So they do it on a kind of a rotation thing that they'll do inventory. Now, everything must be counted at least once during the year, and that's one of your audit steps, is to make sure that everything is counted. But a lot of times they will not do one big inventory at the end of the year. They do it throughout the year. So if you're going to audit Walmart, your inventory work auditing work has to be done throughout the year. Okay, just because that's the way they do their inventory. It would be impossible for them to do a big inventory at the end of the year. There's not enough people on the planet to do that. And two, inventory is a moving target. You know, stuff comes in, stuff goes out every single day. So, you know, to shut down Walmart for a week or something to do inventory would be, you know, billions of dollars, impossible. So anyway, a lot of times, you know, the companies, that's the only way they do inventory. Okay, so most larger, so then that's true for Walmart, you know, Target and all those other stores. Well, almost all big stores, they take inventory throughout the year. Now, year-end work. This is generally considered better evidence. Stuff that's done at year-end. You know, the problem is that time is very precious at year-end. So you say, well, why don't we do anything at year-end? Well, because the time constraint on year-end. And remember, it's not just the client that you're working on. You probably have a bunch of clients lined up after them that have to get their work done. So it's certainly better evidence. Now, if you have inventory, let's say there's a problem with inventory done throughout the year. Sorry about that. I had to sneeze. So year-end work is better. It's better evidence. However, it's that the time is constraint is much larger at year-end. Okay. So constraint at year-end is much more of a problem than at interim dates. Now, however, it is always the auditor's ability to ask for things to be done at year-end. So it is possible that, you know, for instance, I'll take the inventory one. Usually, if not for large ones, they'll say you have a smaller company that's doing their inventory throughout the year. If you're not satisfied that they're doing it correctly throughout the year, there's problems with controls. You can insist that they do it at the end of the year because it's better evidence. Question on that? Okay. D, first year considerations. Which of the following amounts will be the most difficult to prove at year end? So here you're at year end. So you're in the first year. You get their income statement, and it looks like this. Their sales. Their cost of goods sold. Oops. Here's your operating expenses. So of all these accounts that we have here, which one would be the hardest to prove at year end? Anyone?
I was gonna go for cost of goods sold.
It ends up being the cost of goods sold, and the big one that's a big problem here is this beginning inventory. Notice that this beginning inventory, you can't jump in the time machine and go back and count this beginning inventory. And so if you can't count this beginning inventory, then this cost of goods available, the amount you could possibly sell, isn't right. Your ending inventory, this one you can get a good number on. The ending inventory, nothing wrong with that. And you can do watch them do the inventory and get comfortable with that. But it's this beginning inventory. This is the problem right here. Oops. Because this beginning inventory, we can't jump in the time machine and go back and figure out what the beginning inventory was. Now, if you have a year out in advance, you can come in and give them a report on just the inventory, and then you can be fine with it. But if you don't have that in advance, there's a big problem here with the beginning inventory. All right. Now, so if you can't verify the beginning inventory, and then if it is material, what type of report do they get? And notice, if you don't know beginning inventory, it means you don't know this cost of goods sold, and you also don't know the net income, right? If beginning of inventory is a problem, then this is a problem too. That's a problem. Then this down here is a problem. So what kind of opinion are you most likely to give if you cannot verify this beginning inventory? Now, notice you don't have evidence that the inventory is wrong, but you can't verify it.
Would that be no opinion?
Yeah, sorry, I tried to unmute myself and I formatted it.
Oh, sorry, we can't hear you. Oh, there you go.
Yeah, sorry about that. My screen thing keeps disappearing. I gotta make it so it stays up there. But anyway, so I went to unmute and it disappeared, and then I did some formatting. Yes, this would be generally what you're going to give them, because you cannot verify this beginning inventory. You're not saying it's right or wrong. You don't know. And if you don't know, this, But you don't know this, and you don't know, oops. You don't know that. So, yeah, so this is the kind of the impact that that's gonna have on them. Now, here's another weird thing about accounting or auditing, I should say. And this is one of those things that's kind of like interpretation. It says the opinion on the financial statements taken as a whole. And this is where it gets a little bit strange in that it's possible to give separate opinions for separate financial statements. For example, the income statement, maybe in this case, because you can't verify the inventory, give a disclaimer. Retained earnings, that has the income on it. So that'll be a disclaimer. Whoa. Now let's try that again. Copy. Okay. I think that was our Zoom meeting that came up before. Statement of cash flows works with it, so you may get a disclaimer here. Now, down here, you might get the balance sheet, you might get a unmodified opinion. That's nice, spell unmodified. This one might be unmodified. Because notice that everything is at year end for the balance sheet. So you can, you can see how much cash they have, how much inventory they have at year end, how much, equipment they have and all that. So it is possible that you split up the opinions and you give a disclaimer for the income statement, retained earnings and cash flows, but then give them an unmodified for the balance sheet saying everything is okay. And you may ask, well, why do you do that? You got to realize that giving a disclaimer is like giving them nothing. They go to the bank with a disclaimer. The bank's gonna say, what is this? Why'd you even bring this in? However, if they go to the bank and say, okay, we got a disclaimer for the balance sheet, statement of retained earnings, cash flow. However, we got a clean opinion on the balance sheet. So this stuff on the balance sheet, this cash, these assets, the liabilities, those can be relied upon. Those are, according to the auditors, fairly presented that you can rely on. So it is giving some type of an insurance for, and again, you're charging them an audit fee. You want to do the most you can for the client. Okay, one other thing though I want to mention, and that is, it is possible to give a qualified opinion if it is just one account. So for instance, if it's just it is possible to give this as a opinion. And it's possible as an opinion to give the qualified if it really is confined to one account and you don't think it's pervasive, that it's throughout the entire document, you can actually give them a qualified opinion. Now, generally speaking, a qualified opinion is not available if management is not allowing you to get the information. So if management is not allowing you the information, generally speaking, they don't get a qualified, they get a disclaimer. But if it's not due to the fault of the client, it is possible that they get a qualified opinion. And it could be qualified for these three statements. It's another option. did something wrong. So it is possible that they get a disclaimer or qualified for 3 of the opinions and then an unmodified for the balance sheet. And again, it's not that you're doing anything underhanded, it's just that you're trying to give the most information you can for the client who has paid you for this audit. And for people trying to make decisions too. If you give a disclaimer on everything, that's not helping the bank any. Are we done? Oh, we're not. We're not even close to done. What am I doing here? Okay, we are not gonna finish this tonight. All right, let's stop here. And let's take a break. What time is it? 6:86. Let's say be back at what, 7? We'll say 7:06. I'll move this up. And we come back, we'll get into I think we'll get started on the bring a blank. We'll get started on the sampling overview. Okay. All right, let's see here. Okay, sampling overview. And test controls. All right, well, first of all, is there anyone that does not have this?
Yeah, is that is it in Blackboard? Cause I don't think I,
I should have sent it to you in your email, but let me see if it is a Blackboard. It should be. I thought I said.
yeah, the email was, oh, I think this is a new one. Okay,
You know, it actually is in Blackboard too, though. If you look in Blackboard, it's second from the end. Or for no, it's right at the end, I think.
oh no, I have it, thank you.
And but we're not going to turn in the chapter 6 handout. It's we're not doing this.
Okay.
Okay, so what this is a sampling overview, and it kind of takes into account some different things in sampling that we're gonna go over. A lot of these come out of CPA questions. They'll ask about these different types of things. Okay, first one is selecting a sample, and a random sample is the best. If you know, if you guys have had your stats class yet, but this is the best. If you have had your sampling class, why do we want a random sample? The reason why it's the best way to sample, I'm sure you guys said it in your other class or not, but it's you try to get avoid bias. So this is the most unbiased way. So unbiased sample, if it's random, it is more likely to represent the population as a whole. So more likely to represent a population as a whole is why we do it. Systematic selection. Any questions on that? So you want your sample to be unbiased. Oh, well, let me give you an example of a bias sample. When I was doing auditing, that we had a lot of paper files still. This is back in the early 90s, 20, 30 years ago, whatever it was. Anyway, we had a lot of files that were still, paper files. And I would open up a file drawer and look at the files that were the most messed up, that had sticky notes and things stapled to them and all that kind of stuff, because those are going to be the ones that had the problems. Now I was doing internal auditing. So it was a very biased file or a selection, because I would just go look for where there's problems, because again, internal auditing, we're looking for problems and how to solve those things rather than trying to figure out the population as a whole if it's it's fairly presented. So it was a very biased sample that I would take. Okay, systematic selection. I would say this is probably the second best. All right, so the second best way to sample, this is when you take usually it's every nth item. So oops. So, you know, you've. Oops, no, I don't underline that. So if you have 300 items, you know, you take every 10th item. You know, take item number 10, you know, 20, 30, you know. It's systematic. So, and you can have a random start. You can say take item 4, item 14, item 24, and you get the idea. Every 10th item. Oops. And again, you can put a random start on it. This is the second best way I'd say. Now, the problem with this is that it's possible that you miss something. For instance, item number 9 has no chance of being picked, even though that one maybe has a problem. And it could be that there's a repeating problem. You know, that happens every on the 9s or something like that you don't pick up. But it's probably the second best way to do it. It can, depending on the sample, it can be fairly random. So I would say systematic selection. I've done systematic, I've done both random and systematic selection. And I also did one time this haphazard selection. And haphazard selection. By the way, these first two are what I would say are repeatable. And systematic, or maybe a better term for systematic. And what I mean by that repeatable and systematic is that it can be repeated by somebody else to get the same results. So, you know, you can do a sample that is systematic and say I take every 10th one, start with number 4, and you get the same numbers as I'll get the same numbers if I do the same thing. All right, so is repeatable and systematic. Haphazard is not repeatable. It's not systematic. This is a way that you basically, let's say, close your eyes and pick items out of the file cabinet. So haphazard, it's not repeatable. It's not systematic. And basically you go to a file and you say, close your eyes, and you pick the items out, you know, like this. You close your eyes and you pick the sample, and those are ones that you use. So you pick 10 of them, you close your eyes and you pick 10 of them, and open your eyes and you have the 10 in front of you. Now, as you can imagine, that's not repeatable, because somebody else closes their eyes and picks 10 items. They're probably all different than the ones that you picked. So haphazard is not a great way to do sampling. It's probably not random, because, you know, a bigger file might be have more chance of getting picked than a smaller file and so on and so on. But it's also not repeatable. So generally you don't see these too much in auditing. I'll tell you one that I did, but let me finish up the screen here first though. Okay, so haphazard. Block sampling. This is probably the worst way to do sampling. Take an entire block of items. So you take an entire block and do the sample. So sample all the sales in October, for example. That would be so the block would be October. My auditing teacher would tell us that block sampling is for blockheads. Does blockheads one word? I don't know. Okay. So haphazard selection. I was doing an audit of inventory, surprise, in at US Steel, and this big building. There's a lot of big buildings at US Steel because they used to have a lot more people. You know, now that we have computers, they used to have like hundreds of clerks making invoices and all that kind of stuff. But so there's a big building, and I was auditing one of the inventory areas where they sell the steel, rolled steel. That doesn't matter. Anyway, there's like 10 people maybe in the place, and so I'm doing this inventory, and there's a special kind of billing for kind of like odd types of inventory, but it's kind of unique because it has all different. You have to be pretty much on your game because they have all kinds of different characteristics, and you try to get the best price and all this kind of stuff. So anyway, I'm in there doing the auditing, and I have to audit these odd ends things, and they say, well, you got to go down the hall to do that audit, do that part of the audit. You know, that's someone's down the hall. So I go down the hall, and it sounds like a party is going on, talking, laughing, and all stuff. I walk in there, and there's just one woman in there, and I said, tell her what I'm doing, and she just kind of stares at me and starts laughing and all that stuff. And it became very apparent that she was, she was schizophrenic. And so I was really just taken back, and I said, well, okay, here's the things I need to look at. And she just looked at me and laughed or said something, or I don't know what, and so finally I just go back to the class. I said, what's going on? And they said, well, she's a schizophrenic and she's not on her medication. And it's a union thing. You can't make her go on her medication. Okay, so what they said, but she's not, and I guess what they were saying is she was gonna retire like in a year. And so she wanted to be away from everybody, and that was fine. And so anyway, so I went down. So I went down there. So I have all these. I have this random sample that I'm going to look for, and then I started going through these boxes that she has, and I can't make heads or tails out of them. They're not numerical. That and you ask her about it, and she would just either ignore me completely, or say something strange, or whatever. And so it's like, oh, okay, well, I don't know. I couldn't make heads or tails out of it. There probably was a system there, but I couldn't figure out what it was. So I called my supervisor, and he says, "Oh, I don't know." He said, "Just take a sample." I think it was 40 items. Take a sample, 40 items. I said, "Well," he said, is it sounds like to me that they're random anyway, so, take a couple boxes, take 10 out of, whatever each box and do it that way. So I did, and it was a haphazard sample. I just closed my eyes, pulled them out. And that's what I used. And the kicker to it was that they were perfect. Whatever. And I kind of know this later that people who are schizophrenic a lot of times are very intelligent. People think like, oh, they're so crazy they can't do anything. No. A lot of times they're like the most intelligent people, but this, disease, whatever, kicks in. So anyway, they were completely perfect. There wasn't anything wrong with any of them. Out of all the ones I picked. So I kind of, I don't know if it was a happy ending, but it was certainly the strangest thing. So when I talk about haphazard, that is maybe not the best way to do things. At least in one time, for me, it was the only way to do it. Okay, stratification. Okay, so they have a list of 5,693 accounts. And this is a partial list of them, so we're just looking at the first 10. So first 10, and then there's a whole bunch of other ones here that we're not looking at. So out of these first 10, which ones are the most interesting? If you're an auditor, you want to look at these first 10 items.
Probably the ones with the larger amounts.
Yep. Yeah, so you might say, okay, well, this one is probably an interesting one. Oops. 6 probably interesting. Maybe 2, maybe not. But yeah, you're right, the larger ones. And notice that, so these are accounts receivable. Notice if this $28 accounts receivable is off, let's say it doesn't exist even, let's say it's 0. It probably doesn't matter too much. $28 out of 900,000, no one's going to care about that. So even if this entire thing was misstated, it may not make any difference at all. It probably doesn't. However, if this was misstated by 77,000, if this one ended up being 0, it'd be very serious. You may have just one account that's material. So yeah, the larger ones are the ones you'd most likely want to look at. Here's a question that I don't think we talked about. Which one would be more likely to be fraud?
The $25,000 one.
Yep. For whatever reason, a lot of times fraud, they do it in nice big round numbers. And it's very odd to have a transaction that comes out to exactly 25,000. Can it happen? Yeah, it can happen, but it's very unusual. Usually there's a randomness to it. There's actually a type of sampling, type of analysis you can go through called Benford's law. But it's very rare to have something come out to be $25,000 even. And again, a lot of times for fraud, they use nice big round numbers, and that's one of the reasons why sometimes it's easy to catch. There was a case where whenever they were having a short month, they would put it in a sale for 5,000 even. So it'd be, as you look through there, you get the first one at 5,000, and it's fraudulent, and then they would go through and there's a fraudulent one in January. Okay, it looks like in March there's $5,000 one, and it was the same amount. Sometimes they do that, I think people who commit fraud is that they do it because they think they're going to be able to make up for that amount, but I don't want to remember what it is. Okay, so stratification of a sample. It's possible you might break this up into say 3 different categories. Based on the dollar amounts. So maybe for things that are more than $10,000. Maybe you sample those 100%. Maybe you have things that are between say 1,000 to 10,000. You still want to sample those, but probably not as heavily as those other ones. So maybe you sample these to say 20%. And things that are under 1,000. Maybe you sample these to, I don't know, 4%. So everything has a chance of being picked, but the bigger ones, the larger ones, the things you're more interested in, those are things that you will sample at a higher rate than the lesser ones. So things that are under 1,000, they still can be picked, but it's much less likely. And if they go over 10,000, 100% sure they'll be picked, because anything that's more than 10,000, we will pick that item to look at. So this is what is stratification of a sample. This is what they talk about. They kind of make it into, it's almost like a, like a layer cake, that you have the top layer, you do it 100%. This next layer you're still interested in, but not as much. So that, and then under be 4%. Truthfully, this first one, you do stratification a lot of times, this one is not really a sample. It's just simply taking all 100% of them. But the idea is the same. Okay, question on that? So this is what stratification is. And again, it's kind of logical in that it's just whatever the larger the item, the more important it is. You're looking for things that are material. And while you are interested in some of these smaller ones, maybe for the internal control purposes and stuff like that, the dollar amounts are just not enough there to justify sampling too many of those. Where some of these, one of these items could be material. The 77,000, it could very well be material for this account. It's 924,000, 77,000 tied up in one account. Maybe is that one account? Maybe. Okay. Types of statistical sampling. Attribute sampling. These are yes/no tests. So attribute sampling, these are yes/no tests. These are tests that are they're binomials. If you guys did your hold on. If you do your sampling, your binomial sampling is is one of the types of tests they do. So these are yes/no tests. They are oftentimes for us, they're generally only used for tests of controls. Give you an example. Hmm. So, for instance, an example would be, is a purchase order signed by a manager? So you pull out one of the purchase orders, you know, or a group of purchase orders, and for each one, you'll say, okay, is it signed by the manager? And this is yes or no. It either is signed by the manager or it's not. So purchase order signed by the manager, it's yes. It's not signed by the manager, then it's no. So this is these are yes, no tests. We generally use them for tests of controls. These are not used for dollar amounts. You know, just because a purchase manager, just because purchase order is not signed by a manager, does not mean that the item wasn't purchased. Or that it was purchased incorrectly. It just means that the control wasn't followed like it should be if it wasn't signed by a manager. But you know, so here's one thing about tests of controls. We haven't talked about this yet, but we talked about in this chapter or this handout, is that tests of controls are different than what we've done before with the classical sampling and the monetary unit sampling. We were always looking for a dollar amount. How many dollars is it off by? You know, 100,000, 200, whatever it is. Tests of controls do not give you dollar amounts, because it is very possible that something that, even though it wasn't approved correctly, if it was accounted for correctly and it was on the books correctly, and that there wasn't any problem actually with the item that was ordered. So even though a control might be weak, does not necessarily mean the financial statements are misstated. You could have lousy controls, and yet the financial statements are not materially misstated. So they don't give you dollar amounts, but they do tell you if you can rely on the controls or not. And you know, I should probably go over yours. If you've been in statistics and you did binomial sampling, you know that it's really a pain. It can be really complex really quickly, but we have something called the central limit theorem. Oops. And that is central limit theorem is that all sampling types, when repeated, tend to mimic the normal bell curve. And the nice thing about the normal bell curve, or you know, with the kind of normal sampling that they talk about me and the norms, is that it's very easy to use, a lot easier than some of these wacky ones. So it's kind of like this. What the central limit theorem says is that no matter what your sample looks like, if you do it enough, it's going to look like the Bell sample. So if you have a sample if you have a distribution that looks like this, if you do it enough, it's going to end up looking like this. And I know it sounds a little bit counterintuitive, but that's kind of what the central limit theorem is all about. Which is good news, because when you have a normal, the normal bell curve, this is much easier to work with than, the crazy stuff you may have here. And you can, for us, it's like flipping a coin would be for the attribute sampling. So you're flipping a coin, you have two possibilities. One is heads, and the other is tails. Right? It's one or the other. Kind of like our yes, no. This would be like, yes, no. So heads or tails. Now, after one flip, you have a 50% chance of heads would be 50%. Tails be 50%. Oops. So kind of look like that. It's not continuous, but the idea would be to be, 50% for each one. Two flips. Now, assuming the order doesn't matter, okay, it's possible that both of those would be heads. Heads and heads. It's possible that you'd have tails and tails. It's possible that you would have a head and a tail, and a tail and then a head. Now, again, if the order doesn't matter, the odds that you'd have one head and one tail, notice that, this would be 25%, this would be 25%, and this would be 50%. Because there's two chances here out of the four possible outcomes that one's a head and one's a tail. And if the order doesn't matter, which it doesn't to us, so, if you were to, kind of looks funny, but maybe this would look better. Even after just one flip, it starts to go into a normal distribution. So this is what the central limit theorem is kind of about, is this idea. And again, how does that relate to what we're doing? It relates to what we're doing in that we don't have to go through these crazy binomial things. We can simply use the normal distribution. Question on that? It's kind of a wacky thing, and it's. I'll be honest with you, because you when you see it, you don't. It doesn't make intuitive sense, but as you work through it, you actually find that it does work. But yeah, so the central limit theorem is that everything looks like a normal distribution if you take it do it multiple times, and so then you can get nice numbers out of it. And another thing that the numbers get pretty crazy in binomials. So a lot of times, if you do it on a computer, you get into a lot of rounding, which can affect your. And so there's a weird thing that for some really large binomials, that doing an estimate is actually more accurate to doing the actual on a computer. Okay. Because there's less rounding. Discovery sampling. These are usually done with sampling tables. In our case, for discovery sampling could be discover anything, but in our case, usually it's oops. We're looking at the chances of a fraud occurring, and that is, if you take n items, let's put numbers in here. They can use different ways, these tables. They can, but let's say that you pick 50 items are picked without indicating fraud, then it's then there's a 70% chance that a fraud doesn't exist. Okay. And the more items you pick without finding a fraud, you pick 100 items are picked without fraud occurring, then there's a, whatever it is, 88% chance that fraud is. So this is kind of the idea is the more items that are chosen without indicating fraud, there's a greater chance that it doesn't exist. You can also do it if there's our error rates, but for us, usually it's if it indicates fraud, then there's a problem. Classical sampling, we already did. Mean per unit. Use capitalize that. Ratio estimation and difference estimation. Okay. So we already did those. Oops. Yeah. I'll simulate this one. How about monetary unit? We just did that one. Dual purpose test. This is when you're testing more than one thing. Oh, wait a minute. I gotta go back here. These so classical sampling, we're testing for dollar. Oops. Let me change this. This is called testing for variables. And what we're talking about is dollar amounts. And it's the same for this down here for monetary unit sampling. We want to figure out what the dollar amounts are. So both classical sampling and monetary unit sampling, we're testing for variables, dollars. How many dollars is it in the statements? You know, is out by 10,000, 20,000, 30,000, whatever. Attribute sampling doesn't tell us. We don't know if the dollar amount's off. We have no idea if they're off just because those aren't being followed. But classical sampling and monetary unit sampling, we're looking for dollar amounts. Both classical sampling and monetary unit sampling are usually much less involved than attribute sampling. Test of controls. Let's take the purchase order. There can be dozens of controls on purchase orders. Did a manager sign off on it? Did someone for purchasing sign off on it? Was the item approved by the purchasing department? Was the item was the vendor approved by the purchasing department? There's really dozens of them. It's not unusual to have test of controls be 30 questions of yes, no. It's not uncommon at all. So test of controls are usually much more involved than the variable sampling for variables, because sampling for variables, you just look at the one number and you don't care whether it was approved correctly or if it wasn't approved correctly or whatever. You're just looking at that one number. It's one test. You know, what is this number? What should this number be? Whereas test of controls, again, was it approved by manager? Was it, approved item list? Was it the vendor approved? Was it, all kinds of stuff that goes into it. That was the purchase price approved? Was it, the price on the purchase order match the price on the invoice? All this kind of stuff. You don't have any of that with sampling for variables. Sampling for variables says look at the dollar amount, and was that dollar amount put on the financial statements, correctly? Basically, is what you're looking at. So, sampling for variables, sampling for dollars is usually much less involved than sampling for variables. I said that wrong. Sampling for dollar amounts is usually much less than test of controls. Now, part of the test of controls will have in it is the dollar amount accurate. So notice test of controls probably has in there, certainly has in there, I would say, is the dollar amount calculated correct? Now notice, we can use that item in both the test of controls and in the substantive test, the testing for dollar amounts. We can use that one item in both of those. So if we're going to pull a random sample of say 100 items of test controls, and we do our test of controls on those items, very involved, but one of those things is going to be the dollar amounts. Well, it's a random sample. We can include those in our sample for the dollar amounts of the sampling for variables. And I say, well, why are you talking about that? Well, because down here you might have, say, test of controls. Maybe it takes, let's say, 100 items. Required. And By the way, these are all called substantive testing. Another term for the same thing. You're looking for dollar amounts. So if you have test controls and you have substantive testing. For dollar amounts. Oops. And maybe you have 500 items required for this. Okay, so. The test controls are usually done first. And substantive testing are done second. So how many items are you going to pick for the substantive testing? Hold on a second. So how many additional items are needed? So we got our test of controls. We picked 100 items. Now we go to the substantive testing. It requires 500 items. How many additional items are we going to pick? Hey, you guys are sleeping, aren't you? I'm gonna cry until you guys tell me. Okay, fine, I'm not gonna cry. Dual purpose test. All right. Ready we're close to 8 o'clock. So dual purpose test, you have to pick additional. $400 items. And why? Because 100 items would be dual purpose. You would use these 100 items in both test controls and for 100 of these, so you don't have to take another 400 items for substantive testing for dual purpose. And unfortunately, we are out of time again. This is a good place to stop anyways, because this is kind of a new thing coming out next. Okay, well, we're not going to do this. But next week we will. We'll put this down, finish. And we will finish this next week. I promise. All right. So second week in a row. Nothing to turn in yet. But we'll finish it. I promise we'll finish the next class. Any questions? Okay. Well, have a good night, and again, good week. I will be, next week, I promise we'll finish those. Okay.
Okay.
See you guys later.
Thank you.
Have
All
a
right,
good
have a
night.
good one.
Good night.